Hello, everyone, and welcome to LPL Market Signals. Jeff Bookbinder here with my friend and colleague Kristian Kerr to talk international today. Kristian, how are you?
Very well. Plenty of uh plenty of headlines to discuss here, so should be
Yeah.
more than enough to talk about.
Yes, maybe we'll have to reserve a special podcast for just policy announcements this week. We can do that next week because boy, is there a lot there. But we're going to focus on international and earnings season. So here you see our agenda. It is Monday, January 12th, 2026, as we're recording this. Solid week for stocks last week, despite all of these, what I call domestic and foreign policy whirlwinds. And boy, there's a lot of it. Number two, can international equities lead again? Of course, they led in 2025. So we'll spend good bit of time talking about that. And then next, earnings preview. That's the topic of our weekly market commentary for this week. Looks like there's a really good chance, I don't want to call it a layup, but a really good chance that earnings will grow double digits again and keep that streak going. Then we'll close with a preview of the week ahead, and there are certainly some important economic data points in addition to a lot of earnings to follow this week in the financial sector. So we'll start with the recap here. I mean, I've got a list. I'm sure I left some things out here, but a list, Christian, of all the policy news we got last week, right? We know we got the news in Venezuela. We know the president has told Fannie and Freddie to buy 200 million mortgage-backed securities. We have single-family home restrictions. Institutional asset managers, this is a threat anyway. Institutional asset managers may not be able to buy single-family homes. We have jobs report, of course, on Friday, and then we have the defense whipsaw, I call it. So you have initially it was reported that the defense companies wouldn't be able to issue dividends or do share buybacks, and that caused those stocks to drop. But then President Trump followed that up with his plans to try to increase defense spending by 50%. That's impossible, I'll say, but certainly the arrow is pointing up on defense. So that's my list of all the news from last week. You may want to add to that.
Yeah, I'll throw in, credit card fee caps,
Good
the
point.
IEPA uncertainty that was supposed to come out Friday. Taking stakes in energy companies would be another one. Greenland, obviously this morning or over the weekend, the news about kind of the DOJ investigation into some Fed members. That's oh, and Iran as well. Right? We've got that's
Cool.
kind of fallen in the back burner. So yeah, I mean, quite a few things to talk about and try to figure out kind of their impact on markets.
Yeah, I mean, clearly the market was fine with all that stuff last week, although some of these things came out after Friday's close. But S&P 500 up 1.6%. The it was risk on because the Russell 2000 was up almost 5% last week. The Nasdaq outperformed too, up 1.9%. So call it risk on, a little bit more cyclical value type of week than than a growth week. You see, I mean, consumer discretionary isn't cyclical value. Part of it is, and that led. But you had industrials up 2.5%. You had materials up almost 5. We've talked a lot about commodities in a certainly seemingly a cyclical bull market, and energy did pretty well. So is that market sniffing out stimulus that's coming soon, Christian? Is it something else? I mean, the economy, the jobs report seems to be hanging in there pretty well.
Yeah, I mean, listen, the broadening out, I think, is something we've been talking about, maybe looking for. But yeah, no, I also wonder, just from there was a lot of negativity surrounding the economy. I think late last year, coming into the start of this year. You look at the data and it's holding up fairly well. So maybe that's part of this as well, is that kind of the more negative expectations were perhaps a little bit too negative, and markets have kind of sniffing that out a little bit. I would think that's kind of been part of the driver of the cyclical rally. So yeah, I mean, I think there's a few ways we can look at it, but then, then trying to parse through all these headlines and how that impacts. I mean, I think it's still very early days. I try not to, you know, buy in too much into the first few weeks of trading, just because there's a tendency to get moves in both directions at the beginning of the year. I think a lot of that is driven by the fact that every institutional manager in the world just had their P&L reset to zero. So there tends to be a little bit more angst at the start of the year. And typically, I like to give it a few weeks to kind of see where the real trends are developing. But certainly the broadening out that we're seeing is good to see, and we'll see if it has legs, and it's not just kind of a first week of real trading kind of phenomenon, and there's something more to it.
Yeah, I mean, a lot of people are going to ask about each of these policy announcements and how much are they going to affect the market? Well, it's important to just look at the impact on earnings. So clearly, lower mortgage rates can help the housing market. So when you look at some of the winners last week, you see some housing names. That makes sense. Clearly, if credit card lenders can't charge as much in late fees, they're not going to make as much money. That makes perfect sense, right? So that is an earnings impact, right? But some of these foreign policy announcements or risks are really not going to impact earnings for the S&P 500. So they're probably not going to be big market movers. Now, the Fed independence challenges, add that to the list, right? The charge, I guess, or it's actually not even charges. It's just an inquiry or an investigation, I guess, into Fed Chair Powell, that he made some misleading remarks about the renovation of the headquarters. I think it's all just kind of noise. But we did see precious metals rally on that, Christian. So maybe I'll go to the next page and we'll see the precious metals index was up 5.8% over the last 5 days. That is a big move. Clearly, concerns about the Fed are are going to help precious metals. Thoughts there?
Yeah, I mean, listen, silver went to new all-time highs today, kind of, I think on, at least seemingly on the back of that investigation news, saw some dollar weakness in response as well. I mean, I think here's the thing with a lot of this stuff, markets have gotten very short-term oriented over the last few years, and kind of, I think a lot of these things are quite important. The one I'll talk about a lot with respect to metals is what happened with the Russian invasion of Ukraine. If you looked at it from a short-term lens, it didn't matter. And then clearly, since that happened, we saw dramatic changes in the gold market with respect to, Eastern Hemisphere central banks, basically needing to find other reserves. So I think, with a lot of this stuff, you have to think, okay, is it a near-term impact or is it a long-term impact? I think if we were to see something change materially with Iran, with what happened last week in Latin America, I mean, these are things that could have long-term impacts that I think eventually could impact earnings. We're seeing it with some of the mining stocks with what's going on with the gold market. You could trace that back theoretically to what happened, in the Ukraine in 2022. So, I think there is kind of a time frame aspect to this that we do have to think about. These things are important. It's just will the market trade on it immediately, or is it kind of more of a multi-quarter, even potentially multi-year type of impact? And that's really the caution that I would throw out there sometimes, is we want to dismiss some of these things as not being significant, and they can have kind of knock-on effects that will impact markets over time.
Yeah, and certainly if U.S. energy companies can operate in Venezuela freely and comfortably, and they can triple their oil production over there, that's very meaningfully economically, right? So
Yep.
it'll take years to get there, but that is obviously not just a geopolitical risk that's sort of a theoretical risk. It's a real fundamental, could have a real fundamental impact over time. In fact, we certainly hope it does. Maybe you could see something similar in Iran, but there we're talking about years again, or longer. So let's keep moving. Here's your S&P 500 chart, Christian. And I mean, I don't know if it's too early to call it a breakout, but I mean, we're holding up pretty well in trading today. on Monday. So, I mean, do you think we've seen enough to call this a breakout, or do we have to maybe stay above it for a couple more days?
Yeah, I mean, I think that 7,000 level is really kind of the psychological kind of number that we're watching. It's just above, technically where the breakout point is, but I think that's probably the level you want to see us get traction over to get more excited about kind of a more impulsive move higher. I'd also say, if you look at other indexes like the Nasdaq or the NDX, Nasdaq 100, it's still kind of in that consolidation triangle type thing. You'd want to see that kind of joining into that move, assuming we do get through 7,000. That said, I know a lot of technicians are excited about kind of the Dow theory trigger that we got last week. So, Dow making new highs, transports confirming that as well. So there's a few positives going on here, but for me, just specifically on the S&P, yeah, I'd want to see us kind of get a sustained leg, above 7,000 to get more excited about something more impulsive here to the upside. Again, I tend to be a little more cautious around the start of the year because I know there's a propensity to have a few moves both ways. So if we can get through there, kind of right out the gates and kind of stay above there, I think that's really technically positive, something that I think most technicians are probably looking for here.
Yeah, as we're recording this chart, I priced this morning. And we are down a little bit. 69.74 is where we're trading right now. So that is not far from the
Yeah.
7,000 levels. That'll be an important technical test. That's a good point. But certainly you gotta break through these recent highs first, and we're in the process, hopefully, of doing that. All right, let's turn to international. And I think this is a question that a lot of you are asking. Because international did so well last year, and Christian, as you know, these things tend to go in long cycles. This is just 2025 performance of some international benchmarks against the S&P 500. But as we'll see in a bit, when you have, I mean, this trend of international underperforming has been going on for quite some time.
Oh yeah. Yeah, I just want to show here, how stark the outperformance was last year. Just taking kind of some of the you know the the key benchmarks. So MSCI, basically all world ex US, EFA, so developed markets, emerging markets, and they were up towards 30+% versus the US had a great year, up around 18, the S&P was. So it was a good reminder that, I think going in the last year, probably the most consensus trade on the planet was that the U.S. would outperform, just given that we were in, years of doing so. And a reminder from an asset allocation perspective, why you have international in portfolios, because you can get years like that where they can kind of help uh, with giving you some other kind of return streams. So just, an important aspect, from an asset allocation perspective it's not uncommon to get this. It's just, we've been in a very kind of unique period, I think post-pandemic and probably even going back to, as far back as just after the GFC, really. And we'll talk a little bit about that. But if you want to go to the next chart, Jeff, I think this shows what kind of you were alluding to. So this goes back to 2014, and I'll talk about why that's significant. But think of it, and over the last 12 years, so this is basically a chart of MSCI World ex US versus the S&P 500. So when this chart's moving down, it means international broadly is underperforming the US. And there's really, in the last 12 years, there was last year, there was 2017, and there was 2022, where we saw international outperform. So, if you talk to kind of old hands in the market, they would say kind of what you were suggesting is that when you get a period of international outperformance after a long period where they've struggled to keep up with the U.S., you tend to get kind of more than a 1 year move. That hasn't really been the case over the last 12 years. We have been getting these kind of one-offs. And I think the main reason for that is the U.S. dollar. I think that's really the significant, piece to the puzzle here as to whether we're going to get, a multi-year period of outperformance international or not. And I think we go to the next chart, Jeff. It's like that's really what I'm trying to highlight. Is so that's that same chart versus the U.S. dollar index. And the U.S. dollar index is basically a basket of the dollar against several developed market currencies, but it gives you a good idea of what the dollar is doing. And again, the reason why I chose that 2014 period is you can say, the dollar really bottomed in 2011 post GFC, but really started to get going in 2014, had kind of a secondary low and really started to move up. And you can see that kind of on the left side of this chart where we had kind of that big impulsive move higher in the dollar. And what happened, that kind of kicked off this trend of international underperforming versus the US. And I was talking about kind of on the last chart where it was 2017, 2022, and last year. What really drove that? Well, 2017 was kind of that counter trend decline in the dollar at the start of this multi-year uptrend. So kind of had that first move down from that, and lo and behold, that coincided with international outperforming the U.S. that year. But we were in the midst of a longer-term bull market in the dollar, cyclical bull market, and as that kind of restarted to the upside again, we saw it only be kind of a 1 year aberration. And 2022, a lot of people might say, well, that was, that shows or that the dollar was pretty strong that year, and how come the international equities were able to outperform. But really, if you kind of look in close to 2022, that's where the dollar kind of really peaked out, and that was so far the high of this cycle. But we had kind of dramatic weakness towards the end of the year. Remember, that's where that fall, that's when the S&P bottomed, equity indexes around the world bottomed. Really, you could say driven by the Fed through their tightening policy, started to break things. We saw kind of, interest rate crisis of some sort within the UK, and that kind of forced the Fed to start backing off, at least in terms of guidance in their policy. But we saw kind of dramatic weakness in the dollar towards the end of that year, and that's really what helped propel that modest outperformance by the end of the year from international. And then last year, obviously, we had the kind of the worst first half in the dollar index since the 1970s. And if you look closely on that chart, the international performance that we got came really in the first half of last year, and kind of went sideways for most of the second half of the year. So really driven by that dollar weakness. So really what I'm trying to show here is that if we're going to get kind of a multi-year move or outperformance from international equities versus US, it's probably going to hinge a lot on whether the dollar is entering kind of a cyclical bear market, and we'll talk about some past instances of that. But I thought it'd be good to maybe look at the dollar index here and kind of where we are to try to answer that question. So this next chart kind of shows that long-term trend channel in the dollar. So this is basically the up cycle that we've been in since 2011. Really, like I said on the last chart, really started to get going in 2014. And it's been a pretty steady move higher, some back and forth, some backflowing along the way, but this, you can argue, is why we've seen kind of this UX exceptionalism trade pan out. And if you look at where we are now, we've kind of been up against these levels for the better part of a year, is we've kind of testing that long-term trend channel. And I think if we're to see this break definitively, that would be the case, or that would be kind of the catalyst to argue that, hey, we could be entering a period of more pronounced international performance within equities versus the U.S., because you would start to have that bear market, that dollar bear market kind of tailwind, which would help kind of see that potential outperformance. So we're up against a pretty critical threshold. That green line on this chart is it's the 40-week moving average. This is a weekly chart, but basically a 200-day, roughly equivalent on the weekly. And we actually last week managed to close above it. Came off this morning with some of that news that we got. So we're kind of at big levels in terms of whether we're finding a bottom against this big support, or whether we're going to go challenge it. And like the chart shows, we actually went through that big support last year and then came right back. So the more times you test the level, the higher the chances of you breaking it. So I think we're really, really critical points here. You probably want to see us get back over kind of 101 in the dollar index to suggest that we've maybe found lows up against this support. Every time we've gotten back up, the 100, 101 area, the market sold off. So I think that's a pretty clear key level, and I would say right around 97 in the dollar index, around those old lows, 96, 97. You see us take that out, then that would argue that we're starting to see a more material breakdown in the dollar, which would point to more potential international performance in the year and possibly years ahead. And kind of to show kind of my point here, this next chart is I took the dollar versus MSCI World ex-US versus the S&P going basically in the 2000 to 2008 timeframe. And really the important area to watch is like 2002. And essentially what we saw here is kind of in the late 90s, early 2000s, we had a very kind of similar situation. You could make the case we had kind of a dot-com, tech-driven bull market. Most would consider it a mania, but you had a lot of money flowing in the U.S. You saw the dollar moving higher, and then when that broke, and similarly that broke a very kind of important trend line in 2002, we started to see the dollar enter a cyclical bear market that lasted about 6 years. And when that happened, you can see on the chart in 2002, that really started a 6 year period of the rest of the world outperforming the U.S. And I think that's really what we need to see here if we are going to get this multi-year move that I think a lot of people are looking for, and then I think we've been missing is that dollar component of it. And that's I think what's been very different going back to 2014 is that we've been in a very, very clear cyclical bull market in the dollar. So in order for that to change, I think you need to see some dollar weakness start to manifest itself. And again, we're at pretty critical levels, but we were to see us break down 96, you could start bringing in the potential we get something along the lines of 2002 to 2008, where it's a period where you're going to get that dollar weakness being a tailwind for international equities. Something I'm watching very closely and just wanted to flag, here at the start of the year because I know it is kind of one of the more important questions investors have been having as we start 2026 is whether this trend that we saw last year is going to just be a 1 year aberration, or is it really the start of something more significant? So keep very close eyes on the dollar here, as I think that will help us answer that question in the weeks and months ahead.
So, Kristian, I get that it's technical where you want to watch that support level, but are there certain policy developments or frankly anything else that you think has the potential maybe fundamentally
Yeah.
to drop the dollar by 5-10%, which could cause a repeat of the international outperformance that we saw in 2025?
Yeah, I mean, I think
Is
I
it
think a
rates?
few things. Yeah, I mean, I think what we came in this morning and saw the dollar kind of on the back foot on some of this news. Kind of the question I think a lot of investors have is kind of what we're seeing with some of these policy initiatives is that bring about a sell the U.S. trade, just kind of a
Mhm.
maybe trying to do too many things from a policy perspective that sees kind of maybe people lose a little bit of confidence in the dollar. I think that's definitely kind of a big one, just given all the policy headlines that we've been seeing over the past week or so. That would be the clearest one to me. But then, really FX, foreign exchange is driven a lot by interest rate differentials. If you look at some of the currencies like the Australian dollar, for example, markets there are expecting the RBA to start hiking fairly aggressive here this year. So you start getting a big spread in terms of interest rate differentials between the rest of the world and the U.S. That'd be another thing to watch closely here. Markets are starting to price that in a little bit. So that'd be another thing to be looking for. And then lastly, growth. If we were to see kind of growth materially pick up in the rest of the world, I think that would be another fundamental rationale for why you'd expect the dollar to come under a little bit of pressure, because it really has been the U.S. kind of leading things over the last decade or so. So if you start seeing the rest of the world kind of take over that mantle, that's a kind of your classic dollar bear market, rest of the world currency bull market type scenario. So those are things I'm thinking of. But for me, it's first and foremost technical. The narratives will come, but if we do see the price action, that would really bring my focus to this idea that we could get kind of a multi-year move. in outperformance of international equities versus the U.S. is something that I'm very closely watching, as I think we're at levels one way or another. And again, it could go the other way. Say the dollar does turn around here. There's plenty of if a lot of the things that the administration is trying to do, that could see a lot of capital flow in the U.S. That's ultimately what drives FX rates is more money moving into that region versus another one. That's kind of what creates demand for the currency. So, if some of these initiatives are successful, you could see a lot of money coming into the United States. That could be a very clear bullish catalyst for the dollar as well. So, from my standpoint, let the price action dictate, and then we can figure out what the what that narrative ends up being. But kind of where I'm at right now.
Yeah, certainly the pace of AI adoption and how much enthusiasm we get for the AI rollout in the US, that'll be a factor as well. So a lot to watch there. One last thing though I'll add, it's not true for EM, but EFA, Developed International Equities, has very little tech. So another way that international can outperform is if US tech does not do well. That's not our expectation, but that is a big delta there. I think the MSCI EFA index weight in tech is somewhere around 7%. In the S&P 500, it's about 34. So big difference, big difference. So tech really matters in this race as well.
Yeah,
So
so in there, Jeff, like that's kind of what kicked off things in that 2002 2008 timeframe. It was we'd gotten the term lower. The dot-com bubble had burst. Uh, so that's really what helped kind of reverse those flows in '02. So something that again another I don't necessarily that's not our view, but if you're looking at possibilities here of what could change things, certainly, and that had a big impact on markets in general. It wasn't just about international. It was value did very well during that time frame. It kind of changed the dynamic of the market because we went from very very high growth focused to more value focused. Commodity sectors did very very well. Things like materials did very well in that time frame, and you saw kind of tech become a lower part of the S&P 500. More commodity sensitive names became a bigger part. Saw a big move in oil services during that time, for example. So it has the chance, if this were to happen, it could dramatically change the complex a little bit versus what we've gotten used to over the last, call it 10, 12 years.
yeah, something to watch for strategic investors,
Yes.
right? That's maybe not a call you'd make for this year, but there is a lot of rotation possibility here for sure as this AI build out progresses. So thanks for that, Kristian. Really interesting stuff. I know a question a lot of you are asking, it's rebalancing time, or for some of you anyway. So see, international does so well. A lot of you are very light there after the underperformance for so many years. So maybe a good time to reassess that exposure. So turning to earnings, again, this is the topic of our weekly market commentary. I think the main headline is that the double-digit earnings growth streak is going to continue in all likelihood. Consensus is 8% right now, and based on recent history, it looks like even 13, 14% is very realistic. In fact, last quarter, companies beat by 7 points. The average over the last couple of years is right around there. It's even a little bit higher. So there's really no reason to worry, we don't think, about some sort of economic inflection point. The economy is doing fine. I mean, we know Q3 GDP was excellent. And generally speaking, the data suggests it's been maybe a very gradual slowdown, but still steady growth. You've got a weak dollar. Speaking of the dollar again, that's a tailwind for earnings. And then you have this massive AI investment that we know didn't just all of a sudden stop in Q4. In fact, it's been accelerating, if anything. So you got these really big tailwinds. We don't even have stimulus really affecting this yet from the One Big Beautiful Bill Act, which is going to be, close to 300 billion of stimulus in 2026. That's coming for Q1, 2, 3, 4. But just looking at Q4 of last year, it's really hard to envision anything worse than low teens. Here's the Mag 7 earnings growth estimate for Q4. It is 19%. So, could potentially quadruple the rest of the market. The Mag 7 has been blowing away estimates now for many quarters. So you're probably going to get something in the high 20s here when all the numbers are in. And the 5% that the rest of the market is expected to do probably could get close to 10 when you factor in upside, but there's still going to be a pretty big gap. So for those thinking that this should be the year of value because this gap is going to close, we're not quite there. That's something we're watching, but we think it's too early to overweight value here in anticipation of a narrowing earnings gap between the Mag 7 and the 493. But still, these are really strong growth numbers from most of the market, frankly. By the way, the tech sector alone is going to be probably like 80, 85% of the earnings growth in the quarter. It's really unbelievable how much impact that has. Here's your profit margin chart. It's just going up and up and up. The fact that corporate America has been able to grow margins, expand margins, despite tariffs is really impressive. And so if margins were up in Q3, we think there's a good chance they'll be up in Q4. And then once all these tariffs are digested, or at least we think they will be, then it'll be even easier to push margins higher. So, and this doesn't even really include much of a margin benefit from productivity due to AI investment. We don't really have a ton of that just yet. That's going to be a very long-term trend. But I mean, a little bit of a tailwind in 2026. So we have a lot of confidence that we're going to see more margin expansion ahead. And that actually is one of the reasons why our earnings estimates for 2026 are probably a little conservative. So Kristian, as you know, it's kind of a tradition here at LPL Research that we put out our annual outlook, and then within a month or two, there's something that's not quite right. So here I would say that our earnings forecast, which I felt pretty good about, I think the whole team probably felt pretty good about when we put it out there. But then as you see in this chart, this shows you consensus estimates for 2026, the top line, and consensus estimates for 2025 on the bottom. Look what's happened over the last few months. That 2026 estimate it's just kept climbing and climbing. So, it was more in the low 300s when we put our earnings estimate out there of 290. Now it's 309, and increasingly, again, as the AI investment gains steam, we may be a little low. So I like the idea of having a bit of a cushion in case something goes wrong. And we certainly have seen, again, so many policy changes. Some of them are earnings negative if they happen. It's nice to be a little bit below the street to have cushion against some risks. So 290 in 2026 seems very reasonable. That's high single digits. Consensus is more in the mid-teens. That seems a little bit rich. But if you're growing, if you're spending as much as companies seem to be spending on AI, and that starts to bear fruit in 2026, Kristian, maybe low to mid-teens earnings growth this year is possible. What do you think? Stimulus is helping.
Yeah, for sure. I mean, listen, and we kind of go through this. Yeah, I look at more on a quarterly basis, but every quarter it seems, the street's always a little bit light on what these companies are going to do, and I think that's been a big driver of the moves we've been seeing since at least the lows of 22. So a lot of it makes sense to me. I think where it gets challenging is when the hurdle gets to be very, very high, right? Like that's typically, I view it more from like a behavioral aspect. You start getting really, really high hurdles, then it's, you're kind of due for maybe having a period where kind of market's got a bit too optimistic, but right now everything seems fairly reasonable, and if anything, I think the hurdles are too low at the moment. So I think a lot of what you say makes sense here, Jeff.
Yeah, remember that earnings estimates tend to come down about 10% from where they're first published,
Yeah.
which happens about 18 months in advance. And then once you get into the calendar year, So obviously we're in 2026. We're not reporting earnings for any of 2026 yet, but we're in 2026. The average reduction in estimates is somewhere around 5% in the calendar year. So, if you take $15 off of this, somewhere in the mid 290s, that's not too far away from where we are. So we think that's where you should be thinking about right now as a potential earnings number. And again, the stimulus from the One Big Beautiful Bill Act is big. It's like 130 billion in consumer tax cuts and other savings for consumers. It's a little bit more than that, something like 135, 140 billion in business tax incentives. So that's going to flow through to earnings. It's one of the reasons why we put industrials on our shopping list. We think the industrial sector is going to be a really interesting sector to watch this year as that stimulus starts to come through. And even though the job market's slowing and we've been a little bit cautious on consumer discretionary, those tax savings numbers are pretty big. So watch that sector. Maybe it's closer to an overweight than an underweight, but we're still neutral consumer discretionary. So those are two sectors to watch, in addition to tech, which you always have to watch. It's just such a big part of the market. So we start off with the banks this week. JP Morgan Tuesday is a biggie, and then another 11 S&P 500 names in the financial sector reporting this week. So it's a big week for earnings. In addition, we get the CPI and retail sales. So any thoughts on those data points here, Kristian?
Yeah, CPI is probably the big one for me this week, just after the wild number we got last month. I think the market's going to want to see, if there's any sort of normalization in that. So I think that's big. And quite frankly, I think all the other things that we talked about, kind of these policy initiatives are going to be what drives it. But certainly tomorrow's inflation number is going to be probably the fundamental macro event of the week in my mind.
Yeah, there's some wonkiness to I guess, the data collection over the last couple of months. So
Yes.
there might be some noise in that number. So maybe don't, if it is a touch hot, I mean, frankly, based on a lot of the other data we've seen, we do think we're in a period where there's just a little bit more inflation than we want to see. So maybe that'll come through in that number. Hard to say, but it's really going to be January, February CPI numbers before you sort of have a pure number, I think. And retail sales it's the holiday, getting closer to the holiday shopping season, right? So that's going to take on some importance. We've already seen, I guess, a couple of pre-announcements from retailers. There'll probably be more, but all indications are that we had a decent holiday shopping season in terms of overall sales, kind of up in the neighborhood of 4% year over year. So again, not necessarily a reason to recommend buying consumer discretionary names right now, but you've got the stimulus coming and holiday shopping was okay. So that is what we're watching for the week ahead, although I'm sure there'll be more policy surprises. That seems to be the trend. So buckle your seatbelts, but at this point, we have not seen reasons to change our asset allocation from where it started the year. So thanks, Kristian, for the great comments on international and the dollar. Really important to watch those currencies when you're talking about international investing. And then again, weekly market commentary on LPL.com on earnings season preview, which should be a good season. It's hard to know whether the stock market's going to really react to it, but should be solid numbers from corporate America again. So with that, we'll go ahead and stop. Thanks everybody for listening, as always, to another edition of LPL Market Signals, and we will be back with you next week. See you then, and take care.
See you next time.